the cloud. All right, so we just had a correction period of 10%. For those of you that were in the XLK position, you technically didn't really correct to 10%. You corrected to, I think it was 8%, because as you know, if you're in ETFs, they don't move the same as actual singular stocks. So when you had major stocks that were in the ETFs, like for example, your Apple, your Microsofts, your Intels, your Nvidias, and Adobes, and so on, that combined collectively really brought the XLK ETF or sector to a 8% drop. Now, a lot of what you saw this week, and we see corrections trigger for whatever reason, sometimes economic, sometimes just from unpredictability, sometimes for certain economic catalysts. One of the biggest catalysts was that, one, a lot of folks were expecting for the stimulus checks to come out, for the $600 extra in unemployment, and our Congress has not been able to come forth with an agreement there, so that's unfortunate. But either way, a lot of folks also believe that what we saw in this correction was also due to the fact that we're reaching quadruple witching. And I've talked about quadruple witching a little bit extensively, sometimes over extensively. A lot of folks have been getting a little spooked about quadruple witching, but really I think it's more hype than anything else when we look at the quadruple witching period. When we see a quadruple witching period, though, like I said, you see a lot of major contracts expiring. So for example, you're going to see the VIX expire. Many of the futures contracts expire. So Dow, NASDAQ, and S&P futures, they will expire, along with you have commodities like gold, and then stocks as well. So with that being said, when those major contracts expire, it also opens up new expirations. Now, what I mean by when I say that we're somewhat of an unprecedented point right now, because typically you see options contracts go all the way up to 2 years. There's typically a 2-year cap. We're in September right now, and we're seeing a expiration that is going to be released on Monday. That will be a January 2023 options contract, which really is for a 2-year for 2.5-year contract. So a lot of you are asking, hey Mark, how is it that I am able to calculate the strike price? Because the strike price and what we've known from you has always been, pretty much 2 years. So I brought it upon myself to say, wouldn't it be cool if we had the opportunity where if we could show what would it look like if we were to calculate this. So let me go ahead and try to get my screen up. I'm not going to take up too much of your time this evening because I know that many of you have things to do, and I want you guys to go ahead and enjoy your time with your family or take the time that you have to study. So let's go through it real quickly. So a lot of you have known that I've done the 2-year contract or the 2-year performance where I look at it. So if you look at the XLK, you typically see the 38.52. But it would be interesting if, say, for example, we went to the 54.22. So let's see what that would kind of look like, right? So let's take the existing price of what we know of the 112. We'll just round this up for round numbers sake. So we'll round that to 113. So we're going to take this 54.32, and since we're doing a 3-year position, what we're going to do is we are going to divide this 54.22, or just $54, just for simplicity, 54 by 2. And so the reason why that we do that is because we say that we look at, again, still a year and a half to really make a decision of whether or not we're going to stay in the position or to walk away. Typically, if you're doing a long-term contract, you really want to look at around the year to a year and a half, especially if you're at the 2-year or 3-year. If you're doing a 3-year, it's really the evaluation period. And so you would do a 54.22, divide that by 2. Now, here's another cool thing, especially for those of you that are already in positions. If you want to, you can do the subtraction or keep the formula as it is of taking away the 10% out of the position. That's 100% fair. But if you don't want to do that and you want to get a little bit more conservative on your positions, now this is a cool thing about doing your strike price. So that way you can kind of set like your high, medians, and lows. Or if you just want to look at it in a simplistic format, you do the 54 divided by 2. That gives you 27. Now, what I'm probably going to be looking at doing is multiplying that times 0.8, which brings me to $21.60. So then I'm going to take that 21, or I'm going to round it up to 22. Anything greater than 5, you ultimately round it up. So I'm going to take it to 22, and I'm going to add that 113 to the 22, and then that puts me at 135. That lets you know exactly where your buffer points are. So for example, if we took away the percentage takeaways, right? So we say 54 divided by 2, that puts us at 27. Add that to the 113, that puts you at 140. Is everybody getting that math? If you're getting the math, go ahead and just hit yes in the chat, so that way I know that you're still there with me. Though I can't see it, but I mean, still great. All right, so the reason why you're seeing that these numbers are like, wait a minute, Mark, these are the same numbers that we're seeing for the January 2022s. That is 100% correct. But the reason why you also have to take that into consideration is because we also just corrected in the market. The NASDAQ corrected by about probably 10 to 13%. So if you put it into perspective, if you want to make it easier on yourself, because we're going to rebound from this 113, and we will definitely go back up to where these 52-week highs are. If you're looking for a range now, you can do, for example, the 27, or let's play around with it, right? So let's take the 54. We're going to say we got 54, and we're going to divide that by 2, which gives us a year and a half. So a year and a half puts us at 27. Year and a half, year. Divide that by 2, put you at 27. Multiply that times, let's say, if you want to stick to the script and do 0.9, you can do that. That takes away the 10% correction. That puts you at 24.3. So we're just going to say 24. So then what you'll do is, if you want to do even further out, you could do 24 plus the 127, or 128 if you round it up. That puts you at 152. And then, of course, if you take away, say, for example, the 20% instead of the 10, then there you have it. All right, so I'm actually getting ready to go to a part where if you would like to be unmuted, go ahead and request to be unmuted. See if I can answer some of these questions. Actually, let's see. I guess it's not allowing me to unmute people, so that's interesting. Oh, there you go. So let's unmute you.
Hi, Mark.
Hello.
Can you just go over that again? I didn't have my pen.
It's okay. All right, so, and this is Ebony, right?
Yes.
How are you on this Saturday?
I'm good. I'm great. How are you?
I'm good. All right, so let's do it again. So let's take the XLK strike, right? We'll take the XLK price of currently, I'll show you the low, and then I'll also show you the high. So on the low side, we're going to take instead of the 2-year, we're going to take the 3-year. And the reason why is because if you're playing the January 2023, it's at the 2.5-year. So we're going to just round that up to 3. So we're going to take the 3-year price and say 54, and then we're going to divide that by 2. Still with me? Ebony, you still there with me? Did we lose Ebony? Is Ebony still there?
Hi, I'm still here. It wouldn't let me unmute.
Okay. So yeah, just don't mute yourself until we're done.
My bad.
All right. So did you see how I did that though? The 54
Yes.
and then we divide that by 2?
Yes.
Okay, good. So now that we divide that by 2, so that puts us at 27. And then what I'm going to be doing, this is what I'm going to be doing personally. I'm going to, instead of be doing it by 9.9, I'm actually going to be multiplying that times 0.8.
Okay.
Because I'm taking away 20% as a potential drop conservatively from the position.
Okay.
Now, of course, at any point in time, this position can do better than that, and that's just gravy on top of it for me, right?
Yeah. Yes.
So then you're going to take that 21, or we're going to round it up to 22, just because you're not going to get a 0.5 position in a 2.5 year long trade. So you're going to round that up from 21.6 to 22.
Okay.
So now we're at 22. Now here's the cool part. You can add it either to the low number of where we currently are, which is the 112, or round that up to 113. So 113 plus 22. Or you could take it from the 52 week, because you know that we're going to come back from that and we're going to rebound. So then you can add that 22 to the 127, or just round it up to 128 to discover your new strike.
Gotcha. Okay. Thank you.
Yeah. And coming to you, Aaron. What's good, Aaron?
Nothing much, man. I appreciate everything you do. You know, it's funny because I had the same question. She already asked it, so I have no questions, bro. Appreciate you.
No problem.
All right.
And coming to you, Gary?
Hey, Mark. So I looked at the new calls, and when you look at them, they basically go up to 130. So based off of the numbers, we're just going to the highest one, basically, if that's correct.
Yeah, and I think that what you're seeing right now, a lot of the strikes haven't been established yet because the positions technically don't open until Monday.
Okay. All right. Well, looking forward to Monday. So
I know. I just wanted to make sure that everybody was prepared, and we're just having an all hands meeting. So hopefully that helps.
all right. Well, thank you for what you do.
No problem, brother. All right. Coming to you, I think it's Malone or Malin. Did I say Malone? Is that right? Please tell me.
No, it's Marlon.
Marlon,
Yeah.
like, oh, okay.
Like Ballin Marlon.
Okay.
My question is, how do you come up with the 0.2? I was talking to my buddies. We got a little group chat going on amongst ourselves, from everything that you teach us.
Yeah.
But my question is, how do you get to that 0.2?
How do I explain the 20%?
Yeah.
So if you think about it, every year the market typically corrects about 10%.
Okay.
So if you take away, if you have a 2 year, because I'm probably sure you're not going to be in there for the other half of the year, so we're going to take that away. Mm-hmm. So throughout, from now until, say, for example, 2022 of this time next year, or this time in 2022, it's crazy to say this, September of 2022, if you can think about it.
Yeah.
You're probably going to have 2 corrections in that process.
And when you say corrections, explain that.
So where the market reaches a certain high, or when positions reach their all-time highs, they correct 10% down from that.
Okay.
So then when we take away the 10%, each one of those years, that equals an equivalent of 20%.
Gotcha. So is it kind of like correct me if I'm wrong, is it kind of like a yield kind of approach?
You actually could think about it as kind of like a yield. Yeah.
Right. Cool.
Yeah.
Appreciate you.
No problem. By the way, I won't get your name wrong the next go round. The next time I see that, I'm gonna be like, I got you. All right, coming to you, Lily.
Hey, Mark.
Hey, hey.
So are you going all in at open or kind of phasing it out throughout the day?
That is the $1 million question that everybody's been asking me. Like, yo, what are you going to do? So typically anytime that I'm playing an option contract, I'm never buying directly at the open. I never do that. And the reason why is because you see positions at their most volatile, which means that you're going to be paying a really, really ridiculous high asking price. And so I like to let my positions settle a little bit. I mean, the biggest thing that I want going in on Monday is I actually want the market to be red.
Right.
I want the market to be red. But if anything, I'm looking forward to around about an hour after the market opens, you typically see it settle. Okay. So the market settles down at that point. And then from there, it becomes so much easier.
Okay, thank you.
No problem. Good questions. Oh, by the way, it's not just XLK that has a 2023 contract. For anybody that's paying attention, you should probably look at ARKK because word on my street is they now also have a January 2023 that has also hit the table. Now, probably not ARKW, unfortunately, but you never know. Things happen. Coming to you, Marianne.
Okay, so just to make sure, there are actually two variables in your formula. The first variable would be whether you want to use the last closing price or the 52-week high. Mm-hmm. And the second variable is the correction. We can use either 10% or 20%.
Yep.
Okay, that's all I wanted to make sure. Thank you.
Yep. So here's the cool part about it, y'all, is when you think about it, each and every single one of these numbers is low. And anybody that was paying attention to my rolling fours, the market is officially going to be giving you a significant gift over the next few years. Okay, so I just said a lot. So let me just go ahead and explain that. So when you think about the market giving you a gift, remember when I did the rolling fours and I said what your target should be? So I said typically 5x, 7.5x, 10x return, which is the same equivalent of, let's say, 500%, 750%, 1,000%. Ask yourself this, how hard is that going to be to reach those strike prices in 2022? Just a little food for thought. All right, coming to you, John.
Hey, Mark, thanks for having me. Can you hear me?
Yes, I can hear you.
So what if you don't have the amount for the rolling fours? Can you just put in what you have, or you just continue to try to make it to the 30K for the 4 quarters?
So when you mean that you don't have enough for the rolling fours, what does that mean? Just so
like,
just for me, so that I can get more perspective to help.
7.5 each quarter.
I mean, ultimately, you do what you can, right? I mean, you do what you can do. Sometimes you're going to find yourself that you're never going to be perfect. You're never going to be perfect at reaching such a financial goal, especially in the beginning. But that's okay. The biggest thing is that you want to build a level of consistency, and that's where the 70-30 rule comes into play. If you're doing well on your savings of 70-30, then it becomes more consistent, a consistent strategy for you in doing the rolling fours.
Okay, I left you a message to try to answer the question about the T-shirt. If you mind, can you check and see if I got it right? And hopefully I did, and I'll be greatly appreciated for that hour power of greatness.
Well, I'll give everybody a hint. I've actually given the answer on a video.
And I think I saw that answer. Was it
nope. See, I had to mute you there. I had to mute you there. See, you're not supposed to be giving away answers to the class like that. Everybody's got to do their own research and their own learning. All right. Do we have any more questions? Oh, we do. We do. Coming to you, Daniel Royal.
Hey, how you doing, Mark?
I'm all right. How are you?
I'm great, man. Just want to tell you I appreciate everything you do for us, man.
Thank you.
I have a question for you. Okay, when you it's kind of speculation, but are you expecting these numbers to come out in the cents range or in the dollar range? These initial numbers on XLK strike.
Am I expecting them to come out in the cents range?
You
Or
know, like
is like cents available?
yeah,
Like
like
the
87
price per
cents.
contract is in
Yeah,
cents?
yeah.
No, I don't think so.
Okay, we're gonna be looking in the dollar range. You think?
Yeah.
Okay, all right. Just wondering. Thank you. I appreciate it.
It's a good question. I mean, now, of course, I can be wrong. I can be very wrong. And if I am wrong,
Then we gonna all eat.
I'm just going to say this. I'll put it out on Instagram saying, yo, I'm giving y'all a head start.
I appreciate it, Mark.
Not a problem. Oh, what? All right, coming to you, Travis.
Hey, how you doing?
I'm all right. How are you?
Doing good, man. Just appreciating this blessing you putting on us. I got a little quick question. When it comes to, like, whenever you're looking at the 2-year forecast and you determining where you think a company should be at the end of, 2 years, how exactly do you equate that into the percentage of returns you should be getting? Like, does that make sense? Like whenever like you saying like you should, you want to set a goal for 5x return, 7x return, 10x return, and you're looking at where you think a company should be. How is it that you could how's it that you get that, I guess, to the end of, all right, well, if I get a 7x return off of this company and this company is, they grew 30% or 40% over the last, 2 years, which that's a lot, but how would you equate that into, okay, well, I should be getting back so much money from my investment?
You're looking at more so the option itself. So you're looking at the bid. You're looking at the bid itself and adjusting. As the stock essentially grows, and so too will the bid and the asking price.
Okay.
So, for example, remember when I did a quick lesson on the Greeks and talking about the delta?
Yeah.
As the stock consistently rises, and then on top of that, the delta gives you two different things. It tells you, one, it tells you what the probability of the position is reaching in the money. And then two, what it also tells you is what the movement is per dollar in the stock movement. So for every dollar that stock moves, then that's exactly how much the option goes up in value.
Okay. All right. Well, thank you. Thank you.
All right, coming to you, Mr. Matlock.
All right, there we go. My guy. So my question is, so I actually am in Ian's elite club too, and so we did the how to read the charts today. I think, did you get in there? I think he was in there, wasn't you?
I don't know. I heard that there was somebody who was posting like
okay, so the question I really had was about, like, when you use the Bollinger Band and you have a pullback.
Yep.
The way he was showing us, it's guaranteed to get back to that line. You just gotta be real patient. It just take months to years. But I was assuming that eventually that bottom line is going to start to come up and that's where it's going to meet. And is that the time you need to just be patient and wait for that to happen?
At times, yeah. It can definitely be like that.
Okay. Because when I'm looking now, I feel like there's still pain to go.
Yeah, but see, the thing is like, if you're looking at the further pain for specific stocks, then yeah. But the reason why I like trading out of ETFs, though, is because you can have other companies that can offset some of that pain.
So with ETFs, I shouldn't expect for it to go down to the lower Bollinger then.
Let's take a look.
Yeah, I'm looking. Yeah, because I'm on XLK on the week, and it's just like so wild, yo.
Are you looking at it on the week, or are you looking at it at a longer period?
I got it on the week right now.
Okay. Here's 6 months. Can everybody see this?
And then I mean, as far as time period, I got as far as back to 2019.
Got it. Okay, so let's look at it on a simple line chart. And here's the funny thing. Sometimes you have to do your retracements back also to where the stock once was. So for example, if we're looking at August 11th, back to where we were Friday, 9/11, we closed at 112.96. But back on August 11th, we were at 111.38.
Okay.
So I think where we're at right now, and if we go to, say, for example, bar chart opinion and look at, say, for example, where that support is, boom.
Oh, shit.
Kind of cool, right?
Yeah, thank you, brother. I appreciate that.
That's when charts become magic.
Damn. All right. Thank you.
All right, coming to you, Antoine.
Hey, what's up, Mark? We appreciate what you do.
Thank you.
Right. So and what you just did with that chart was pretty sweet too for the last guy. That was impressive. But my question for me and the guys that we deal with was when we trade options, sometimes we put in a stop loss.
Yep.
So if we make it to our 500% or our 750 or our 1,000.
Y'all asking me to give you like more cheat codes tonight. Okay, let's do it.
Yeah. I'm nervous if I mess with it because I've been burned a couple of times when I got out of something too early messing with the stop loss.
Well, that's the biggest thing. You have to examine where you are at in the landscape of time. So
Okay.
you have a 2.5 year long position, right?
Yes.
So if you're up 500% in 9 months, are you getting out?
From what I do now, yes. That's just how I feel, you know. This is new to me. This part.
You got to remove your feelings from the equation.
Exactly. So no.
All right. So let's say, for example, you go up 750% at, say, for example, the 12-month marker.
Okay.
You get out?
If it's a January 2023, no.
Okay. Why?
Because I want to get to 1,000.
But that's a feeling.
It is a feeling.
How do we remove the feelings from the equation?
That's the big thing, right? You know, and that's why I was worried about, like, when to get out. That's why I talked about the.
So let me give you a hint. Actually, let's just give some game away because it's gonna be recorded, and I'll try to drop it on the Come Up Cousins Facebook page.
Okay.
So if we're looking at it, right? Let's say you're at 500%.
Yep.
And you're like, okay, there could be more room up ahead. I typically say that you should give yourself a buffer of about 10 to 20%.
Okay.
And then what you do is you reestablish a new stretch goal, hence the 7.5, the 750%. If the position keeps running up, then you leave it there. You leave it at that buffer period of where, if you're, let's just say 10%. If you're at 500% and it keeps running past the 500, but you have a 10%, then that puts it at 490%, right? For your buffer.
Right.
But then when it gets to 600%, are you reestablishing a new buffer?
Yes.
What's your new buffer?
10%.
So what is the new buffer?
Oh, 600 was that. Now I'm doing math in my head. From at 600%, 10%. Oh man, put me on the spot. 590 or 580?
590.
590, yeah.
You just take away the 10% from the 600%.
Just keep changing it.
You're just dropping it in, and you're just dropping it in levels of 10.
Levels of 10. Okay, I mean, that makes sense to me. Okay.
So then what you could do is when you get to 750, you say, all right, the other part where you can take solace, because by the time when you reach that, let's say that by the time you reach that 750% at the 12-month marker, you can roll and then take the profits off of the table and then keep the position rolling.
Okay, that makes sense. Thank you.
No problem.
Thank you.
Coming to you, Jeremy.
Hey, Mark, man, honestly, I really don't have no questions. I just got to express complete gratitude, brother. It's crazy to me to have this blueprint to really change the dynamic of my family's last name, you know, and for that, I'll be I tell everyone about you. People think I'm crazy right now. Like, it's so I'm like, all right, you talk to me in 2 years. Like, honestly, that's what I keep telling. My wife looks at me. The other day, I was literally sitting and watching the Come Up series, and I was bawling to her because I can see the light at the end of the tunnel, man. And so again, man, like, I just really, really, really wanted to express what it is to know and see and understand that there's people out there doing this for us, man, doing it, showing us how to really be successful, because it's true. If you follow anybody, if you follow any of the individuals talking about how to change it, and it comes to equity, man, equity. It's the only way we're gonna get there. And you a pillar of that. You put Wall Street Trapper, Ian, EYL, Derek Grace, all you guys, man. Like, honestly, it's insane to me. I didn't pay this much attention in school, and I put hours into educating myself how to become free. So for that, man, like, continue to be the superhero you are to all of us, man. I bless you. Many blessings, brother.
Thank you. Y'all, so, I mean, for me, it's like, I wish, like, you know, like, it really eats at me every time when I see that, you know, I'm always asking myself, what could have been if the people around me had this, you know, just having this information, what would it have done for their families? And so for me, it's like, it's something that I also wrestle with, because I feel like I should have came to the stage a lot earlier. And partly the reason why I didn't come to the stage was probably because of selfish reasons, because of the fact that I was too worried about myself, in the sense of, you know, hey, is the community ready for what is it that I have to bring? Or also, do they even want to hear what I had to say? So, I mean, the biggest thing that I wanted to tell each and every single one of you is thank you. Because, you know, honestly, real talk, every episode that I do, every live, I'm nervous. I'm literally nervous because of the fact that I want to make sure that I'm giving each and every single one of you the value that each and every single one of you deserve, because you work very, very hard for your dollars. You put the time in. And my thing is that I just want to be of service to each and every single one of you, that you can now know and have some form of assurance to know that, okay, hey, that the knowledge in which that you're gaining, you know, honestly, it's like you can do something with it. I mean, when we think about, like, let's say, for example, that person who works their hard-earned $10,000, and $10,000 is all they have worth of saving. You put that towards, say, for example, a 2.5-year return, and let's just say hypothetically that turns into a 20x return. You know, do the math, 10,000 times 20. That's game changing. So for me, it's like, who am I to withhold this information and this knowledge from that person, and whom which that can definitely do something to, you know, literally influence, you know, their lives for the better. So no thank yous necessary, all y'all. It's just more so in the sense that I thank you for just receiving me and helping spread this message and helping spread the word. And for those that don't want to hear, okay. For those that do hear, great. Not everybody's going to be ready, and that's okay also. The goal is that, you know, the folks that are ready, then let's go on this journey. If they're not ready, maybe later on they'll be ready once they see your success. I mean, each and every single one of you will be able to further this message and further the mission far beyond what is it that I could do. And this is, like I said, this is just the beginning. So with that said, let's keep going. All right, so coming to you, V. Uh-oh, I think you went mute on me. Not hearing the sound in your on here. Oh no, oh no. You're about to switch, she's switching over her audio device. And just think about it, y'all, if we're at 50,000 subscribers, we're not even there yet. Just imagine what happens when we change. Like, remember what I said, there's levels to this. There's levels to this. My first goal is to help each and every single one of you build a point of liquidity. That's the first mission. The first mission is all about liquidity. Yeah, V, I still don't hear you, so I don't know what's going on, but we'll wait. The first level is liquidity. You know, can somebody put in the chat what's the next level? Because I think I did mention it on the come up series. All right, so V, I'll come back to you. All right. All right. Well, actually, there's no other, because I think I've already spoken to Gary Walker, so I guess I can lower his hand. Aaron, I already spoke to you. Ebony, I already spoke to you. Coming to you, Duran.
Peace, Mark. How you doing, brother?
I'm all right. How are you?
Oh, man, I'm doing fantastic. Just putting together some strike prices and looking over some things, man. But I had a, yeah. So, you know, we talk a lot about, well, we don't do nothing. I sit here and listen. You talk a lot about ARKK and ARKW, right?
Mm-hmm.
And, you know, I've been listening to a lot of things of what Kathy has had to say. I've followed the ARK Invest. And then I just been doing some more due diligence on the research and things of that nature.
Okay.
Now, there was a video that she said, she was like, look, our heaviest investment is in Tesla.
Yep.
And I've seen that also through, you know, just the percentage wise, but everything that she was talking about and, you know, the ride hailing, everything that you went over, you know, and anybody that has read anything about Tesla and has really been in touch with it, man, they are beasts, right? But I know you're talking about like, hey, listen, you know, when we start putting together these strike prices, it's essentially for the ETFs itself, right? Because if I'm gonna do it for just an individual stock itself, then I'm gonna put is it a higher correction that I'm doing, or am I doing the 0.8?
Oh no, you're definitely you can definitely do a 0.8. It depends upon the movement of the stock, and that's where you get to use the research of what happens when the stock actually corrects. More volatile, the stocks that carry the most amount of momentum, they correct more than 10%.
So when we get to the part, basically like the last part, when we multiply the price that we added together, instead of doing 10%, you're saying do how much? Because I must have missed that in the video.
Say that one more time.
All right, so check, like, you know, once, like if we were doing like an ETF and we get to after we got the current price and we added up, I mean, we did the, you know, divided by 1.5, we got the new number, we added that to the current price, we come up with that price, right? And then that's when we go ahead and multiply it by the 10% for that piece of the correction. Are we still multiplying that by the 10 with an individual stock?
Depends upon the timeline, but yeah, you can still do that.
Okay. Okay.
I mean, the other part where you can use to validate whether or not your strike price is on par, and I always tell people this, look at the earnings, and then on top of that, look at the analyst research, and the analyst research also gives you a price target.
Okay. And then also, when you're with the ETF being so heavy in a position of I know like there's other, you know, companies in the ETF that are going to essentially help it bounce back if one is to fall. We get that. But if they're so heavy in it, why would we not just go with that stock?
Because if you go with the stock is always going to be more expensive than the ETF.
Say, there you go. That's all I had to hear. That's what I need to hear. Okay.
Yep.
It's going to be more expensive and I can have the more. Okay, cool.
What you can do for future reference is just always go check this individual stock and look at their options chain, and then go look at the ETF and where it sits. And then you can also see that the options chain price, the asking price is different.
Mm-hmm. Okay.
Sound
definitely. Good? Yes, that was perfect. Appreciate that, bro.
Not a problem.
Peace and blessings to you. Thank you.
Likewise. Have a good night.
Peace.
All right, we're gonna come back to you, V. We hope that everything is well. V, you there?
Hey, can you hear me?
Yes, we can.
Finally! Goodness gracious. Okay. Hey, Mark. Here's my big dilemma that I've been wrestling with.
Okay.
So I've opened up the E-Trade with the IRA. It's going to take a couple of days to happen.
Okay.
All that sort of stuff. No problem. So my dilemma is either trade on Monday with cash out of my individual brokerage. The reason I'm struggling with doing that is because of the taxes I'm going to have to pay by coming in and out of, that position over time, kind of what you guys talked about in one of the videos. I'm struggling with that because if I do that, then I'm going to be leaving money on the table, which sucks. So if I don't do that, then I'm going to miss out on this opportunity of probably getting in on some good prices. And then I tell myself, well, I mean, is it really that bad if you pay taxes on some pretty amazing gains? So that's kind of where I am. My boyfriend and I have been talking about it. He's opening up an account as well.
Okay.
So what are your thoughts?
Here's my thoughts and how I would come forth in making that decision. I would have to ask myself, is the benefit greater than the temporary pain?
Okay. Say no more. Dag on it. Mark.
Sorry.
No, you're fine. It's just that you're absolutely right. And that's how I have to see it. So eventually when all the accounts are settled up, then I can just eventually transfer everything over to the E-Trade IRA and run it as Christopher was sharing with us the other day. Sweet. Thank you.
Not a problem.
Even though you say don't thank you. So this is me not thanking you.
There it is.
All right. See you later.
Have a good night.
Okay, good night.
All right. I think I've answered everybody's questions unless somebody has any more questions for me. I'll go into my quote unquote Jerry Springer final thought. Monday's going to be pretty awesome. And there's going to be a lot of excitement because of the fact that this is unprecedented. But here's the thing to remember. Keep a level head. Also, there's going to be a lot of folks that are going to want to try to jump into the party, and that's okay. This is a long-term position, so you've got time. Like, this is, for anybody that knows me, knows that the greatest thing that like, if I feel like my time is wasted, I'm upset. If I feel like I lost money, I'm not upset. The reason why is because I value time over money. And so you've got time now. That's what you just bought. You bought time in a January 2023 call. And whatever you're going to go for, you've bought yourself time. So I guess the biggest thing that I can say to you is use this opportunity wisely. And don't just stop learning and seeking more information and learning about, like, if you're in any of the ETFs or any positions, keep studying, keep researching. You should know, like, off of the skin on your body, you should know these 15 companies that are the top 15 in any ETF. You should just know that. So I just want to say, I'm proud of each and every single one of you, because if you think about where we once started, and mind you, the come up is less than 60 days old. And look at how far we've gotten. I mean, people were once upon a time hitting up my DMs asking for a strike price and everything else. And now each and every single one of you are able to discover your own strike prices. Many of you are able to study the information. Many of you know, you're starting to learn the skeletal system of what makes a company. You're starting to understand the financial scope of companies even better. So kudos to each and every single one of you. You guys are going well beyond, well beyond what I'm probably sure what any of you have ever expected. The conversations that you are probably having is probably nauseating to everybody else around you. But it's dope. And like I said, it's like when I see that happening, then I definitely believe that we're on mission. And yeah, we're rebuilding something that was once stolen. So keep it going, keep learning, keep studying, keep asking questions, keep supporting each other, and the movement gets only bigger. And when we get to a certain point, you'll be surprised. The other side will never know what was coming, and they never saw it coming, and they never saw it. So I'm proud of each and every single one of you. Have a good night. I'm happy the Lakers won. Sorry for the spoiler alert to anybody. But have a wonderful night. And until next time, I don't know, should I do another one of these Zooms or something like that in the future? You know, I don't know. Should I do another one of these Zooms? You know, you never know. Oh, wait, we got another question. So let's go to Shay. I'm gonna try to answer this question. So Shay, how you doing?
I'm good. How are you?
I'm all right.
Okay, so I have a question about the strike price calculation, because in the Facebook group, I'm seeing two different ways. I'm seeing one way where you take the 2-year performance, divide it by the 1.5, and then you're taking the correction of that. And then the other way that I'm saying it is by taking the performance, dividing it, adding it to the existing price, and then correcting that. So which is the correct way?
Do they all correct by 10%?
Yeah, so one is just correcting the performance piece and then adding that to the current stock price. And then the other is adding the performance and the stock price and correcting it in total.
What's the price differentiation between the two? Do you know?
Off of the top of my head, no. I'm just saying that whenever people are asking about the strike price formula, I'm just saying it two ways, where one, they're correcting just only the 2-year performance part, and then one where
You're going to hear it directly from me.
Okay.
Either one works, because essentially you're taking 10% away from the price. Now, preferably me, I like taking 10% away from the performance. But it's okay if you're taking 10% away from the entire price, from the entire strike price as well.
Okay, great. Thank you so much.
Not a problem. All right. And my last question, because I just went through that whole final thought. So coming to you, Tevin. Is this Tebow?
No, this is Tavon.
Oh, okay. I was like...
I appreciate everything you do. Again, thank you for all that you're doing for us. I had a question just kind of regarding the IRA and using that as like a tax benefit or to reduce the amount of taxes that you get. So is it better to trade your positions out of your IRA and go ahead and take the penalty? Like say if you want to withdraw it before the 59.5, is it
withdraw like the capital from it?
Yeah, is it more tax beneficial to just trade out?
Why would you be doing that so soon?
I guess depending if I need it. But I guess that's also what the individual brokerage is for. Mm-hmm. Okay, gotcha. I just want that clarification. Thank you.
All right, y'all. On that note, and just for Tevin, go and check Thursday's episode with Christopher Bush, because he definitely dropped some serious knowledge and jewels there. Just rewatch it, because you may have missed something, because I know he definitely went through the process of explaining that one. But thank you, everyone. Thank you. So it's 8:30, officially my time. Thank each and every single one of you for joining me, because you didn't have to, but thank you. And until next go around, I may actually bring on more. So who knows? We may have another session like this in the future. But I will drop the recording in the Facebook group if you came in late or if you missed it. So don't worry, don't freak out if you're just joining. But until next time, I'll see you guys later. Peace.